Good evening. This is Ken Long from Tortoise Capital with a review of the weekend trading report for February 24th, 2013. We have a market that's in bullish normal conditions. It's back into neutral on both an annual and a 10-day basis. Bullish, strong bullish green here with the price with respect to the 200-day moving average and the slope of the 50-day moving average. Both are bullish green. That's strong. ADX has pulled back to just a strong trend. It was extremely strong before. It's back, ADX back to 30.8. The risk Z and the VIX index here, the risk index, right at 1.0, right at the risk off level, and you see the time series here. So we're right on the boundary between risk on and risk off. So the market's at a potential turning point. That's good for swing trading, as we'll see here in a minute. No change to the blended monthly rebalancing portfolios. That's due on or about 1 March. Theoretical exposure in ETF2 remains at 100%, and so is the model portfolio. This trade of the week link goes to a 22-minute high-quality discussion of preparing for the next day's trading plan. It shows you how to use some of these key indicators, and I think it does a good job of making the connection between preparation and execution, so I'd recommend it for that reason. The blended monthly rebalancing portfolios, just want to highlight that the U.S. risk on symbols, mid caps and small caps, have moved to the top in both of the portfolios, and in the large portfolio, XLF Financials is at the top as number 1. So that's a place to look at rewarding continued momentum. In the market health check, you can see this pullback Wednesday and Thursday was the first real dip back into the river that we've had really in almost 50 days. And the vertical blue lines are 10, 20, and 30 days worth of look back. Horizontal purple lines are price targets. Horizontal red lines are support levels that act as price targets on the downside. Dark blue is the river. That's plus or minus 1 standard deviation in the Bollinger Band with a look back period of 30. The lighter blue is the floodplain, and you can see how price has been staying in the floodplain the whole way up on this long bullish quiet move until this recent pullback to the Bollinger Band main, which violated the regression line channel, which is formed by these black lines. The center line is the 30-day regression line, and then the outer 2 lines are formed by the maximum excursion from the regression line during that look-back period, which happened on Thursday. Red line in the middle of the river is the 30-period moving average. The blue line here is the 50. The red line is the 200, and this is the region under the 200, which would be a return to bearish conditions. You can see right now the river in price is pulling away from the 200, so that's really strong and positive. So this little pullback here should be seen as a buy on dip opportunity by most people, so we're ready to see a resumption of strength going forward. But if it fails through the swing low at 150, we'd be looking at 3 price targets below for the S&P at 149, 146, and 145, which would really put this entire 30-day move at risk. You can see we were overbought for a long period of time and just recently moved into oversold. And the jaws of PPO are open to the downside, indicating a potential for a short-term pullback, which I think could take us really to the bottom of the river, most likely, or the floodplain as a secondary target. So we're ready to trade in both directions. This is the market right on a knife edge right here. Is it a buy on dip, or was that the first sign of a intermediate swing high being put into place? Looking at ETF2 database, the regionals, the globals are still stronger than the S&P. Inside the U.S., it's small caps, then mid caps, and large caps, then tech. The 2 strongest sectors are Europe and then Asia less Japan. The 2 weakest are U.S. tech and Latin America. In the market health check, you can see the strength is returning to the U.S., led mostly over here in the green by mid-cap value. Only large-cap tech, i.e. the NASDAQ, is suffering. Everything else in the Western Hemisphere is kind of weak except for Mexico. Everything Europe is strong except the UK. In Asia, it's a mixed bag with Australia, Singapore, and India strong. Everything else weak. Asia less Japan, and Japan are both strong. Inside the business sectors, pretty much parity between the U.S. and the globals. And in some cases, the U.S. has caught up and passed their counterparts, like in utilities and in energy. Top ETF 30s dominated by small Asian countries. Those that are green in the strength column and white in average are ones where money is flowing into those sectors. So we'd be looking at things like the Russell 2000 value, the small cap value, S&P 500 high beta portfolio. That's risk on coming to play. Mid cap value, you can see that was excuse me, very strong in the market health check. And then a couple energies are doing well also. Looking at the Dow 30 through the same lens, I want you to notice Hewlett-Packard has moved all the way from the bottom to the top now over the last about 2 months. We've watched it go from 13 to 19, and that's sort of the advantage of watching the bottom and looking for value plays as they start climbing the stack. It looks like Intel is red overall, but only yellow on the strength, and so that's an indication of potential value at work. Oh, there's one other one on there too. Look at McDonald's is now white on strength and yellow on average. So McDonald's used to be down here with Intel and Microsoft, and is now quietly marching its way up, as is Disney. ETF liquidity looks at average daily dollar volume. These are the top 30 based on the amount of dollars that are traded, and those in green are exceptionally volatile intraday and make good intraday trading targets. Shifting now to the daily report. Get back to page 1 here. Let's see, we've got overreaction signals in Latin America and emerging markets. We've got plenty of auto framer candidates and lots of ETFs and large caps that are channeling an overreaction. We've got a 5-day down in blended commodities and a triple screen in energy and Disney, and then 551Ws in sector spiders XLY and XLE. That's discretionary and energy, and then tech and European 350 also signaling 551W, as is Home Depot. I like Caterpillar here. It's a channeling and an overreaction. It's the number one max pain range compression. Tests out at 3.3 to 1 on the auto framer and had a RSI 2 value of 1. Bank of America is also interesting. Channeling and overreaction, 2.2 to 1 on auto framer, and is one of the strongest companies in the Dow. So that ought to get your attention. United Health and Alcoa both kind of washed out a little bit over the last couple of days and have very low RSI2 values and test out at 2 and 3 on the max pain range compression, respectively. Inside the ETFs, a ton of patterns to choose from. Take your pick. And a lot of them have extraordinary reward to risk ratios. You can look at the 8.6 to 1 in gold. And it's number 2 on the max pain range compression. Pretty attractive. See on the market mosaic, this little pullback from the regression line, the first time in 30 days it's happened. It's sort of accelerating the decay of the slope of the 30-day regression line. See how that was about a 2% pullback when we look at price with respect to the 200-day moving average. And it's hard for that slope to stay so strong for so long, and so this is sort of a natural pullback. If it does, coming back to 148 would not be unnatural. Just want to highlight the strength in XLP based on what it's returned over the last 40 days and 20 days. This is the Z-score. And then the extreme weakness in Alcoa should get your attention for as a value play or as a sign of weakness in that sector. The Z-scores of the regression lines, the last time it looked like this was here about 4 months ago when there was almost a 10%, maybe 8% pullback here, and that's when the 90 period regression line was up at the 1.0 level, and then the 30 period and the 10 period were both rolling over. You can see that's exactly where we are right now. The weakness of the last couple days has made the 10 roll over. The 30 has rolled back into the Z-score channel here, and the 90 was at an extreme high reading. So the nearest neighbor to this condition is back here, and we saw an 8% pullback, which should at least cause you to respect your stops and make sure that your profits from this powerful move here up are locked in. And that's everything I want to cover from the daily report, and we'll see you in the chat room. It's Ken Long from Tortoise Capital. Keep your powder dry and your risk measured.